The director's loan account is one of the areas that causes most confusion to business owners. So, how do you avoid the risks that come with it? At its simplest, it's a record of all the transactions between you as a director and the company itself. The limited company is a separate legal entity to you, and its bank account is separate to yours. When you set the business up, you probably had to put a bit of money in to get it going. That's treated as a loan from you, the director of the business, to the company. As the company goes forward, there are likely to be more transactions on this loan. For example, you might use cash to buy something on behalf of the company, such as paying for parking or a taxi. Perhaps you use your own credit card for some purchases. In these instances, you've used your money to pay for things for the company. Therefore, the company owes money to you, the director, and it's credited to your director's loan account. The flip side is, there are times when the company pays for things for you. Perhaps you use the company bank card to pay for a personal meal. The main example is when the company transfers money from its bank account to yours, and that money isn't already recorded in the payroll as a salary or declared as a dividend. It's just a cash transfer. In a small business, this isn't unusual. You are the owner and manager of the business, and transferring money to and from your own bank account is relatively common. The key thing is that it is all part of the director's loan, and it must be accounted for as such. There are a number of risk areas in the director's loan account. If the company pays for personal expenditure incurred by you as a director, it must be recorded correctly. It will either be an allowable company expense if it's part of your director's remuneration package, or if it's just personal expenditure, it will need to be recorded in the director's loan account as an amount you owe to the company. If you withdraw more cash from the company than the company owes to you, your director's loan account balance will be a debtor. If this is the case at the year end, corporation tax may become payable at 32.5% on loans to you as the director, if you are also a shareholder. This additional corporation tax charge will become payable by the company if the loan remains outstanding 9 months and 1 day after the end of the accounting period, i.e. by the deadline date to pay the corporation tax. Therefore, you need to review any overdrawn loan accounts to check whether your company is liable to pay this tax. Where you as a director are provided any benefits that aren't standard salary, you may need to report them to HMRC as a benefit in kind on Form P11D. You should review any expenses and benefits for taxable items that could have been missed. If your director's loan account balance exceeds £10,000 at any time in the tax year and you do not pay interest to the company, you will have a benefit in kind charge on the expected interest on the loan. HMRC use an official interest rate to calculate this. You may need to file a self-assessment tax return. This will be the case if you receive any income from the company or taxable income from any other sources. Any benefit in kind you receive would need to be included on this return and is taxable. Good record keeping is essential. If your records are poor, it may mean that expenditure is missed or has been allocated incorrectly. HMRC does provide a director's loan account toolkit that can be found on the gov.uk website. This provides help in this area. If you'd like to know any more, please get in touch with us. I hope that's useful. If you'd like to see more videos where we answer lots of questions on tax and accounts, take a look at our YouTube page. You can also subscribe for more videos.